Hello guys, in this video I'm going to try and answer the question of is it possible to time the market, buy the dips as it were, and to be able to be a bit more aggressive in the market. Some people say this is complete lies and there's no truth to this, and that you should only just invest for the long term, buy and hold. That's the strategy that wins every time. Okay, if that works for you, fantastic. Buy the best names out there that you can and add to them. If you make money, fantastic, great for you. However, if you wish to increase your learning here or try and be a bit more cute with your trading and try and get into the more growthier names and increase your alpha, maybe this video will help you. So there is a certain like checklist that I have or certain things that I check upon a dip or a sell-off, and just to get me thinking of how and when I should be buying a dip or what should I be buying at specific times. So these are so if a dip happens or a sell-off, what has happened with interest rates? If they're increasing, then obviously that's bad. That's more of a strain on the market. If they're decreasing, then things can get that's more dovish, and you can start to think about adding to positions or getting back into the market. What is the Fed doing, or central banks around the world? Are they expanding or are they contracting their balance sheets? If they start to print, then that's pretty much game over. Once there's more liquidity in the market, that's it. Markets tend to go up. What is the government policy? Sometimes they spend so much it's the equivalent of QE. What has changed generally in the market? Which sectors will benefit from certain changes in the world, if there are any? Like you've seen in a previous video, what are the jobs numbers? Because jobs numbers correlate to sentiment, consumer sentiment, and so if everybody's still happy, then dips can and will be bought. Um, Google, which I'll go into more detail, that'll be one of the not so obvious ways of looking for market sentiment. The VIX, obviously, everyone knows about different stress indices. If you do go bearish, then it's a best bet never to bet against America. It hasn't worked out for anyone in the last 100 or so years, so don't go and do that. And sell-offs typically last a good couple of weeks, sometimes 6 or 7 weeks. And then we get different sentiment indicators, which I'm sure you've heard of if you're watching this channel. So you've heard of put and call ratios, greed and fear indices, very helpful. And then the final one, which is the most helpful in my opinion, and I'll be going into some detail later on in the video, is the DIX and the GEX. So without further ado, let's see how we can use Google to help us with gauging market sentiment. So here we have Google Trends, which is just type that into Google, you get it, and you can search for any search term in the world, and it will give you as and when was this most searched compared to in the past. So as we can see here, for the last 5 years, COVID, and obviously it must have peaked around March, and that's when it did. And then from those March lows, that's when the market started to rally. Then you can say, well, there wasn't a double dip, but there was a double amount of interest of so-called second wave in the summer, which was around the 28th of June. And again, Google was able to help you to show that to you. You can say, well, you wouldn't have known that at the time and it's after the fact. And you're right. You wouldn't have been able to pick the exact bottom, but you would have been able to see when things started to change. And once the news is out there and once everybody has taken in the news, then that's when the market has priced it in. And so that's when the uncertainty goes, and markets hate uncertainty. So once you're certain and you've seen the most damage in the market, there's not a lot more that can happen. Therefore, it can be safe or safer to buy the so-called dip, as it were. Obviously, don't go in like 100 times leveraged and going crazy like that, but just to dip your toes in and add in as things start to progress in your direction. Um, so that would be for, does it work for other things though? We've just typed in COVID and that's most recent, but what about other things? So what about a general term like stock market crash over the last, say, 5 years? And as you can see, we had a sell-off in November of 2016. That's when Donald Trump was elected in the pre-market, and then the market just took off from there. And then we have this huge spike here in early 2018, where we had a nice good 15% retracement, if I recall correctly, and you can see massive peak there. And then later on in the year, we had another drawdown in the market in late 2018, early 2019. Again, showing you that when this news had spiked, and then you could have gone into the market. And then most recently, we had the Corona correction or recession. And again, you can see stock market crash there as well. So we can extend the time frame to the maximum that Google allows, 2004. And again, yeah, it was right here. And you can zoom in, download the data, etc., and play around with it as much as you want. You can do it for other things like oops, unemployment insurance. Yeah, it does help if you actually spell the words correctly. So there we go there. And you can see this has a great similarity to the unemployment claims that we have for the United States data. And so it's a great leg up on that. And so you can see when the market had churned these numbers, had absorbed this information, and then decided to reverse course from being selling off. We can also do it for interest rates as well. So interest rates, again, when there's massive news around with it, when we had the GFC, massive spikes there. It doesn't look like much over here, but when you were to zoom in, so maybe if I go to the last 5 years, doesn't quite. Okay, if you were to download the data, I promise you that the 2016 over here and 2015 was a huge jump up because that's when the Fed started to increase interest rates again. And then obviously we had massive news early this year when the Fed cut interest rates to back down to historical lows. So that's what I would use Google Trends for. So obviously it depends on why the stock market is crashing, etc., what the news is, and which terms you would go about looking for there. So this leaves the DIX and the GEX, which is the next thing I'm going to show you. So let's just click over here. Once again, this is a free website. It's called Squeeze Metrics, and I'm going to show you the max chart. So if you look at the blue line, you can see that whenever it spikes, it is called the bottom of the sell-off, and you should be buying. It doesn't quite call the absolute peaks of markets, but it does definitely call the bottom of markets, as we can see here, both in 2018, 2018-19 over here, and most recently the Corona correction. Data only goes back to 2010, I believe, and then if I go to 2 years, you can see it literally got the bottom. So what is the DIX? Well, the DIX is based upon something called a dark pool. So for those of you who don't know what a dark pool is, and you can research this, you can go into quite a lot of depth from this. But a dark pool is an exchange where hedge funds and smart money goes to exchange or close positions and open positions without the other exchanges knowing that they are doing so. Why would they want to do this? Because then the price will not change that much. So they're getting the absolute best prices that they can, and it doesn't become news that other people can use to then trade with. So it's a very interesting way that the pros are using these dark pools, these exchanges where you can't see who is transacting and how much exactly, but you can see the data that is coming out there. And what we can tell is that whenever there are massive spikes, these tends to be times when the market has sold off and then they've determined, right, this is a really good price to get in on the market and we can make good returns from here. And they definitely coincide with the market bottoms. And this has become very, very useful for myself. The GEX is based upon option pricing. Some people use it like the RSI, but it's more to do with how you have certain levels in the market, and if those levels are breached, then we are at a flipping point where volatility can increase or decrease, thus resulting in higher prices or lower prices. And if we coincide with the VIX for the last 2 years, you can see how the GEX is roaring higher here. So we were seeing great, much larger prices. But then once the DIX decided that's enough for us, we're going to sell off, the GEX also fell off as well, resulting in greater volatility in the opposite direction. So that's on a very simple, very layman's terms explanation. I do encourage you to read the documentation on here and also to download this PDF. Type this URL in. Do definitely read this PDF here. It explains the DICs and the GECs in much more greater detail. It's a bit of a mind bender, but once you're over it, once you have read through this, you'll start to understand the power of the DICs and the GECs, and where selling stocks is actually buying stocks, and buying stocks is actually selling stocks. And that will make more sense once you've read through the PDF. It is available on this website here as well, and Squeeze Metrics also has a Twitter account, so you can follow them on there. But essentially, the DICs is something we should all be following, and it enables you to pick market bottoms. And if you can pick market bottoms and then sell off into the rallies, you should stand to make a more in your trading account. So this is one that the other thing is that this data point here, the DICs and the GECs are updated daily. So it's the most frequent sentiment indicator that I know of. It's usually updated an hour and a half after the US market has closed. There are different plans for this website, as in things you can pay subscriptions, etc. You can look at individual ETFs, stocks, and so in addition to that, because there's ETFs that track forex pairs, you can use it for forex as well. So have a look at that if that interests you. Do do your own research on there, and if you want more understanding on what a dark pool is, once again, there are many YouTubers out there who've done much longer videos than I have, which will help you understand that. But this is something that I found very interesting and has helped me. Hopefully, this video has helped you. Please do like the video, share the video, and subscribe to the channel. And I will see you in the next video.